battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. It's episode 155. Welcome back. We have producer Owen back in the saddle. Took a week off for the 4th, and now he's back. So I hope you enjoyed the bonus episode last week. We are quickly approaching Investor Day 2025. Get it on your calendar this year, 2024, November 7th and 8th, downtown Naperville. Producer Owen, put it up on the screen if you don't mind. We've got Dr. Ed Yardeni coming in to speak to us. Phenomenal. He's literally a legend on Wall Street, just like Dr. Siegel, who you saw a few years ago. Andrew Opdyke makes a appearance as well. We've got the Family Office panel. That is November 7th and 8th, downtown Naperville, Hotel Indigo, Dr. Ed Yardeni. You can't miss it. That's our big investor conference. We tell you what we did with the portfolio. We go through the rebalance, the due diligence process. You can't miss it. The whole group will be there. Can't wait. Most exciting event of the year. And we made it even easier for you to register. If you are watching on YouTube or Spotify, go ahead and take a picture of this with your phone. Take your camera out. There's a QR code. All you have to do is scan the QR code. It will take you straight to the RSVP page, and you can register. If that is too high tech and you would like to do a phone call, you can call Julia Hubner, 630-912-8431, 630-912-8431. Investor Day 2025 registration is now open. Get it on the calendar. You can't miss it. My recommendation, my opinion here, take work off. If you're working and you're like, Nick, it's going to be tough to get a Friday for a whole day off, just take the day off. I'm telling you right now, it's going to be worth your time. We have people from all over the country coming in for it. It's phenomenal. You can't miss Investor Day 2025, this year, 2024. So we will jump into this week's episode and article, the Nvidia Hype, episode 155. I just want to, not trying to brag here, but I just want to point out the fact that Nvidia here is $3.32 trillion market cap. It's up 215% the past 12 months. 3,082% the past 5 years. We did record an episode of our podcast, Bullish. If you're not watching Bullish, you should be watching it. We did an episode of Bullish on September 2nd last year entitled Nvidia Lives Up to the Hype. The stock was only trading at $470. We predicted it could double the next 12 months. So, pretty good call. Even our expectations were blown away, though. Nvidia was $470. Now it was $1330 just before the split. 10-month return, unbelievable. Nvidia has everybody excited, nervous, worried, concerned about maybe this whole market is built on hype. Maybe the whole stock market is a fugazi, a woozy, a wazi. The question on investors' minds is the company's future path, and if the general S&P 500 is overvalued because of AI and the hype surrounding companies such as Nvidia, AMD, and Broadcom. Remember, though, determining the proper valuation for companies, and this is what I tell you consistently. We did a show on it. We did a webinar on it, the Mid-Year Outlook. Go back and watch that if you haven't watched the Mid-Year Outlook. The stock market is just a basic math equation discounted by prevailing interest rates. And the faster you understand this, you don't even need one of these. The crystal ball, remember the crystal ball. This thing is so heavy, doesn't really work that well. But why do you not need a crystal ball? Because you have math. And the math equation of the market is earnings times price. So what does that mean? We take a company's profits, not this year's profits, next year's profits. We multiply it by some sort of multiple, and then we discount that equation by prevailing interest rates. So one of the problems that we go through in the market is people are constantly revaluing what earnings are worth. A lot of times companies are very profitable. There's companies that produce all-time 52-week highs on a regular basis. Then there's companies that are going through corrections right now that are still strong fundamental businesses, producing a lot of revenue, producing a lot of profit, but for some reason their stock's down. Well, why is the stock down? Because investors are discounting what their earnings are going to be worth next year. They're saying, hey, maybe they're not worth 20 or 25 times earnings. Maybe they're only worth 15 or 20 times. So the valuation you place on a stock goes like this, and that's volatility in the market. It's not risk. Risk is rather defined as running out of money during your lifetime because of inflation. Inflation is your big risk, not volatility. Volatility is simply that part of the equation, earnings times price. It's the price piece of the equation fluctuating on a daily or weekly or monthly basis. So if you can stomach that, if you can stomach Microsoft one day being worth 40 times earnings and the next day being worth 30 and the next day worth being 50 or 20 or 10 or 15 or 30, just hold on to the fact of the E and the PE ratio, which is earnings, profitability. Microsoft, very profitable. And so what we want to look for in companies is, are you profitable? Are you cash flow positive? Free cash flow. We love cash flow as investors. What are those cash flows worth next year? And then we invest for the long run. And if you do that on a diversified basis, I think you need 50 stocks. You might have 100, you might have 150, but as long as you have about 40, 50, 60 companies, you should be diversified enough to have some companies at any given time that are going up and doing well and producing lots of profits. Maybe some companies that are going through a rotation, not doing as well that second. And over the long run, if that broad portfolio on a weighted average basis continues to produce more profit next year and the year after that and the year after that, your stocks are going to go up over the long run, unless you pay too much for earnings. And that's what people are talking about with Nvidia. They're saying, Nick, Nvidia, I know it produces $60 billion in profit, but at a $3.32 trillion valuation, the company is trading at a 55 forward price to earnings multiple. So 60 billion times 55, that's how you get to about $3.32 trillion in valuation. That's a lot higher than the S&P having a valuation of 20 times earnings. I would just say one thing to that. That is true. But one rebuttal to that would be the fact that Nvidia for the past 5 years has traded at 40 times earnings. Amazon for the longest time traded at 64, 65 times earnings. They weren't even profitable for the longest time. Jeff Bezos was made fun of relentlessly on late night television saying, hey, when are you going to be profitable? You're losing billions of dollars each year. Are you guys going to ever become profitable? He's had the last laugh. Just because Nvidia is at 55 times earnings doesn't mean it's overvalued if revenue and profit continue to rise. Nvidia is expected now to produce $104 billion of revenue the next 12 months versus only just under $12 billion in 2019. Think about that, a 10x almost in annual revenue in 5 years. So why is Nvidia up so much the past few years? Because profitability is up, because revenues are up, because revenues are sustainable and profits are juicy. We love the juicy profits. We love the juicy margins. We love free cash flow. And Nvidia is producing a lot of it. Now, could Nvidia correct? Yes, absolutely. It has many times. There's been multiple times in the past. I think it's been 3 or 4 times now where Nvidia has been down 50, 60% in a correction. If the general stock market's down 15 or 20, Nvidia easily could be down 50%. So if you're going to hold Nvidia stock, you just need to be ready for that. You need to be mentally bracing for the fact that the bigger the PE ratio, the harder they fall. It doesn't mean that the company is a bad company. It doesn't mean it's overvalued. It just means be prepared for a rainy day. Now, if we continue to see Nvidia's multiple go from 55 to 75 to 105 to 205, and there's no earnings growth along the way, you should be worried because that's the tech bubble. That's 1999 when we had Pets.com producing no revenue, no earnings, no profits, and going up every single day. That's like Peloton. Peloton was valued at $56 billion in the height of COVID. Like they were going to sell you 3 Pelotons and then do that for every household in America. We said, this is crazy. Peloton is not worth $56 billion. Interesting company, great company, 3 million subscribers or something like that. It's great, but not worth $56 billion. So if you bought Peloton at the peak of 2021, oh man, you are paying the price today and holding the bag. Same thing with Cisco investors in the late 90s who paid over 100 times earnings for Cisco's stock, and they still have not seen Cisco return to 1999 levels. So great company. Cisco's a pretty good company, but you pay the wrong price for those earnings, then you got to be careful. So here's my advice on NVIDIA, and this is not individual investment advice. It's just general about stocks like NVIDIA, is just watch profitability really closely and just make sure you're using careful risk management on a stock like that. Should you have 20% in NVIDIA? No. And if you do, you should be a little careful there. Okay. That's true of any company. You need to have diversification. You need to have a rules-based process. And if NVIDIA does climb up to 10, 15, 20% of your portfolio, then you maybe want to start looking at taking some profits. Not a bad stock, not a bad company. I think it's going to do just fine for a long time. But you just need to use some risk management. Common sense would be good. There's a lot of people saying Nvidia could be overvalued because other companies will come in and wipe out their competitive advantage. I think that logic is wrong for two reasons. Number one, Nvidia is way ahead of the competition. If you read their earnings reports, you watch their investor presentations, they are so far ahead of the competition. There's people literally hoarding their chips so they can get a competitive advantage themselves. But number two, more importantly, I think about, and the way that Stenger Family Office thinks about the chip business, semiconductors, is more as a commodity, because chips go into a lot of different things. They go into cars, they go into phones, computers. Think about all the AI applications, all of the different TV applications. There's so many chips out there, and it's more of a commodity than a technology. Now, Nvidia has taken the technology of their chips, and they've been able to do even better than AMD, better than some of these other players. But at the end of the day, chips are a commodity, and they track commodity cycles. So when the economy's booming, remember, semiconductors are cyclical. Semiconductors don't just do well forever. They go up and down with the general economy. There will be a point where semiconductors will come out of favor for a little bit. But thinking about it like a commodity style industry is so important, because if you say that Nvidia could be destroyed by competitors at this stage in the game, that'd be like saying Chevron is going to displace Exxon because they're both producing oil and energy. So that's just not true. There's plenty of demand to go around. There's tons of global oil demand, for example. So you can have players like Conoco, you can have players like Exxon, Chevron, Shell, BP, all competing together, producing cash flow and profits. Now, just as an example, those companies, the past few years, you've seen a massive difference in stock price. Exxon's done very well compared to Chevron. Chevron's done very well compared to BP. Conoco's done very well compared to all of them. Why has BP and Shell in particular not done so well? Because they don't know how to use their capital. They don't know how to distribute capital to shareholders. They don't know how to invest. So there are going to be there's going to be a disparity between management teams. So you do have to look at that too. And that's part of the reason NVIDIA has done well, is because Jensen Huang is just an incredible businessman, incredible manager. It's his company. So he's got the founder's mentality, much like Elon Musk does, like Bezos had when he was running Amazon, like Bill Gates at Microsoft. So that's the difference, is you've got a really broad market, and they're operating that market very, very well. So yes, you're going to see possibly some erosion of margin over time. But this AI, this chip market, the semiconductor market is so massive. You can have multiple successful players. And I think this analysis that they're going to get wiped out by some competitors just not based in reality. The bigger risk is that stock goes to 100 times earnings and maybe it's not worth 100 times. So watch PE, watch the math. That's why I've tried to explain the math of this to you, so you understand how companies are valued. Now, I think if you go a step further and you look at most of Wall Street's Perma Bears, who Tom Lee from Fundstrat, getting right on the money. I mean, this guy is just phenomenal. Most of Wall Street's Perma Bears, I think, who he has said are perma wrong, because if you've always been bearish, especially coming out of 08 and 09, remember the bearish doom and gloomers in 09 and 2010, they said, hey, we're going to go back and do a double dip recession. We're going to have doom and gloom in 2011. We're going back to the abyss. They got it wrong. 2011, we had a little pullback, a little bit of slowing, but we didn't go back to 08 and 09. We took right back off. 2012, 13, 14, 15, 16, 17, 18 had a little bit of a down year, but then 19, 20, 21, 22, down year, 23, up year, 24, up year. So if you were a bear that entire time, oh man, you got smoked. And the worst possible part is the guys like Mike Wilson at Morgan Stanley, not trying to just call him out, because there's another guy at JP Morgan who got fired because he was so wrong. He was so bearish for so long. He lost people billions of dollars. It gets me just amped up thinking about these guys, because they have cost people so much money by being bearish, and nobody ever calls them out for it because they don't manage portfolios. If you're managing a portfolio, you're a portfolio manager, you have to be bullish long-term, especially an equity manager. And there's guys at Morgan Stanley, there's guys at Merrill Lynch and all these other places who are bullish, and they have been right. There's guys like Brian Belsky at BMO Harris. So if you look at the guys who have been right and the gals who have been right over time, it's been the bulls. Why? Because over the long run, the stock market favors optimism. Companies figure it out. They make more money next year than they made this year. And the bears, they get it right once in a while, but over the long run, they're going to continue to be wrong. I think are missing the big picture. They're saying today's stock market is like 1999, a tech bubble. But that's just bad math. In the 90s, the S&P 500 traded at 44 times earnings, 2 times pricier than it trades today. Secondly, tech stocks in the 90s didn't trade at 44 times earnings. They traded at 100, 200, 300, 500 times earnings. Compared today with today's tech stocks at 40 times earnings. So 40 is high. It's a little higher than the general market. It's double the general S&P at 20. But here's what we're watching. Earnings are still growing. And so if we can grow into that 40 times earnings, we're going to be fine. And if you don't read these science and technology magazines and journals, you got to get some. Get on this stuff that's going on underneath the surface. Not all the technology is going to work. Not all of it's going to be great. But a lot of it is. You got to understand. You got to listen to podcasts where you can hear a CEO explain where the future is going. Because if you don't, and all you do is listen to financial entertainment, or all you do is listen to your neighbor who has been bearish since 2009 and put all of his money in canned food and gold, you're not going to be able to stay on your plan the next time a correction comes. So get yourself out of that garbage, that nonsense, out of the I get my gold for, I'm not going to say the name of the firm, but I get my gold and silver bars and coins. You know what I'm talking about? You got the, the commercials on TV. I got my bunker filled full of canned food and gold. And I'm not making fun of these people. I'm really not. I sympathize with you because I don't love how the government's going. We talked about that. I'm not going to talk about it this week. I've talked about it ad nauseum last week, the week before. But the reality is we don't have to like what the government's doing from a policy standpoint. We got to make money in the stock market. And the only way you're going to do that is you're going to have to be in equities. Why do you think Nancy Pelosi's in equities? I mean, look at her portfolio. She's buying Nvidia. She's buying, I guess she sold a little bit of Tesla. She's doing JP Morgan. She's doing all these stocks and she's making money. So, and by the way, the Republicans are doing it. The Democrats are doing it. They're insider trading and all this craziness. They're making crazy returns. If you want to be a really good portfolio manager, you should meet some Congress people. They will give you some great tips, it seems like. But anyways, they're in stocks. So if they're in stocks, you got to be in stocks. You got to be in equities because equities are your inflation beating hedge over the long run. Now, really interesting example. And this is what you really have to understand because we did a podcast, we did an episode of Bullish, and we had on Tom Ackman and Grant Newland. And Tom Ackman's the guy who runs the decking company. And he goes, hey, Nick, the consumer is strong. We're not seeing weakening in the consumer yet. Well, who's his consumer? These are people spending $20,000, $30,000, $40,000 on a deck. These are people with money. They have good net worth. They're making money on Nvidia. Maybe even a baby boomer who's sitting on all these gains the past 3-4 years saying, I got to spend some money, and they're building a deck, okay? No slowdown for those people. Okay, we have seen a widening out of the consumer. And so the people on the lower end of the income spectrum are struggling. Inflation has destroyed them the past few years. And that is the sad reality of inflation. It's the sad reality of a big government. It promises to help the little guy, but it always crushes the little guy. Don't ever forget that. But you're seeing a widening out in where consumers are spending money. I have a guy who works at McDonald's. He said, Nick, we're having, I don't like what I'm seeing in the economy. We're putting out earnings reports where we're talking about the consumer's weakening. Don't you think the consumer's weakening? But then I just look at Chipotle stock. They go, Chipotle's at record all-time highs. And just a quick little survey of our office, I don't think a single person from our office has gone to McDonald's the past 12 months for a lunch run. But we go to Chipotle, 2-3 times a week? People are always going to Chipotle. They're going to Roti. They're going to these places. It's a change in consumer preference. So just because McDonald's having trouble doesn't mean the consumer's having trouble. Just because Walgreens comes out with earnings and says, hey, we're not doing so well with the consumer's weakening, Walgreens is having trouble. Well, Amazon's not having trouble. Amazon's booming. They're up 30-40% this year. So you got to be careful of who you're listening to. By the way, Walmart's up 30%. So it's Walgreens' own fault for the mess they're in. They're the only ones that are down like that. You got Walmart at record highs. You got Amazon at record highs. It's not the consumer. It's the type of business that people are running. That's why management quality matters. That's why understanding what companies you own makes a difference. Another false narrative that's consistently pitched by Perma Bears is this so-called lack of market breadth. That means which stocks are leading the market. And they're going to tell you that only 7 or 8 stocks are driving the S&P to new highs. In my opinion, this could not be further from the truth. The equal weighted version of the S&P, that means all S&P 500 companies, every single one of the 500 in the S&P weighted at the same weight, is only 3% lower than its record all-time high. You've got large banks, you've got energy companies, healthcare companies up over 10% year to date. Since when was 10% as your return by July a bad return? I mean, people are getting ungrateful for such great returns this year. I mean, if I told you you're going to be up 10%, 7 months, not even 7 months in the year, and I told you this last December, you'd be like, great, sign me up. But here we are, we're up 10% on all these value stocks, all these great American companies. You're like, oh, that's not good. I could have been up 180% on, Nvidia. Well, hang on a second. We've got a wonderful group of stocks that are outside of the Mag 7. Think about this for a second. Out of 38 mega cap U.S. companies, these are massive U.S. companies, over $200 billion in market cap. 25 of them are up 10% or more for 2024. 25 of the 38. That's pretty good. Of the large caps, there's 231 large caps that are up over 10% for the year, 282 mid caps, 322 small caps up over 10% per year for 2024. So what are we talking about? No market breadth. I mean, this is absolutely bonkers. This is not based in reality. It's not true. You got to listen to the guys who run portfolios, the people running money, not the people strategizing, theorizing, oh, we're going to have a 10% correction. We're going to have doom and gloom. We're going to have 20%. And then they're never right. They're mostly never right, 90% of the time. Then they go back into the woodwork. It kind of reminds me of, if you remember Monsters, Inc., you remember the invisible lizard or whatever who scares the pants off the little girl, the monster. Okay. He kind of comes out, he spooks the little girl, and then he goes back in and you can't see him. That's like the Bears on Wall Street. And nobody ever calls him out. I'm calling him out right now. You've been wrong. You lost people money. And the bulls like us, the optimists, have made people money. So listen to the bulls. Anyways, think about some of these names. Eli Lilly up 61% 2024. That's not an AI company. Walmart up 34% year to date. That's not an AI company. JP Morgan up 22% year to date. That's not an AI company. Procter & Gamble, they're selling toothpaste. They're up 14% this year. What are we talking about? It's only 7 stocks. It's absolutely ridiculous. The narrative that only Nvidia and AI Hype are leading the market is just plain wrong. Hundreds of other stocks are making regular 52-week highs and producing fantastic returns for investors. If you're up 14% in Procter & Gamble this year, A+. Congratulations. You're up double digits. Your plan only calls for 7%, maybe 8% return. I mean, what are we complaining about here? This is pretty good numbers. Yes, the Nvidia hype is real, but so is the hype around the S&P 500. Earnings are up. The market's not based on a fantasy, but rather on the reality of companies producing higher and higher profits. At some point, we'll be due for a correction. If valuations rise to unsustainable levels, markets will correct. There could be a black swan event like COVID 2008 and 2009 or some other geopolitical conflict. So you could spend your entire life worrying about what might happen and miss the amazing stories of what is happening with entrepreneurs and technological innovation. In fact, some people worry their whole portfolio away into silver coins, not to name any names, looking at their stocks multiple times per day, always worried. These people, they're constantly pulling up their app, looking at their phone. How are my stocks doing this second? Oh no, we're down $30. Sell everything. These people freaking out anytime the markets go down a few points. A far better strategy is to buy American companies and hold them for a long time, ignoring the day-to-day carnival barking Mr. Market, like Ben Graham describes. Remember, that's Warren Buffett's mentor, Ben Graham. He said there's Mr. Market every single day. He's telling you, he's just yelling out random prices, 500,000, 100,000, 10 grand, 1 million. It's your choice if you're going to take Mr. Market's crazy prices that he's barking out. In the short run, companies trade on emotions, maybe a bad quarter, what the Fed is doing. But in the long run, companies trade on value creation and earnings. My opinion, ignore the doom and gloom. My advice, stick to your plan. Find something else to do. If all you're doing is looking at your phone, constantly worried, constantly nervous, put it away. Maybe you have to put it in one of those child-proof containers with the timer. Go outside for a walk. Stop looking at your portfolio and do something else. Life is way too short to be worrying about these little market moves. You are going to have a correction at some point. You're going to have some downside. Don't let that keep you up at night. Stocks will be the best asset class over the long run. And I believe if you do nothing and you just stay on your plan here, we'll do some rebalancing for you. We'll make sure you're in the right stuff. But if you do nothing, you don't react to the downside, 5 years from now, you'll be very happy you stayed the course. So that's the topic that we're going to be talking about more in November at Investor Day 2025. It's this year, November 7th and 8th, this year, 2024, Investor Day. Get it on your calendar. Producer Owen, if you don't mind throwing it back on the screen, there's the QR code. Scan it with your phone, register, or call Julia Hubner, 630-912-8431, 630-912-8431. If you are watching on YouTube, Apple, or Spotify, please subscribe, share it with your friends and family, get the good news out to them so they can also stay on their plan. Thank you so much for being here, episode 155. We'll see you next week for episode 156.